Rezco's strategy is to acquire interests in well-managed companies for less than they are intrinsically worth and to timeously position clients in the correct asset classes. Rezco has been accorded the Morningstar and Raging Bull Awards, and Rob Spanjaard, Investment Director at Rezco Asset Management, joins us in studio to chat about their value trend fund and to share their investment strategy. Rob, thanks very much for your time, and we're going to kick off right there. This is not a value fund in the true sense of value. No,
we associate value at a price. So there'll be some, there'll be a share like Richemont in there, which has got a high PE. Even shares like Mr. Price was a great value share a couple of years ago, 7, 8 PE, now got a 25 PE. So we're always comparing it to what's the earnings potential of a company, and that's a key element to us in value, because we're prepared to pay for earnings growth, but we don't want to overpay.
Do you think there's much value in the market as currently, or is it really just sector determined?
I think you've got to go and look for it. We can put in a good punt for active asset management, because that's what we do. We feel if you look for it, you can find it.
Do you, at the moment, do you feel that you're able to add more value through the asset allocation process or through the stock picking? In other words, is it when you look at your equity and you break that down, are there some obvious bets that you can take in the portfolio? Or do you think that it's better to try and time when you move in and out of different asset classes?
Let me just add as well, I think Kevin's fishing because he wants to know when he should start buying the platinum stock. So if in your answer you could tell us that as well, I think it would help, it would help him tomorrow.
We run on a basis, we're looking for companies where any idiot could run it. The good old Warren Buffett thing. Find a business where any fool could run this business, and platinum companies are really hard to run at the moment. You've got the platinum price going nowhere, and the interesting thing for them is the rhodium price. They were getting $10,000 an ounce a couple of years ago. They're now getting the rhodium price the same as the platinum price. Not great at all.
But you know,
and the
with
costs
that
are going
process,
up the whole
but
time.
are you saying then that platinum going forward is obsolete? We're not going to see this demand-supply equation swinging?
It's just, it swings eventually. It's just that I can't see a scenario right now where they're going to start having really great earnings growth coming through. So it's a bit like our gold shares a couple of years ago. We had great fundamentals, but the costs were just kind of grinding on year in, year out. And I mean, we made that same mistake. We said, let's get that gearing impact out of gold shares. And you kind of never saw the price appreciation in the shares because the costs were going up too fast. That's a problem, what we don't like about platinum.
So if I look at your equity part of your portfolio, you tend to not have a huge exposure to resources. You have got some, but not a huge. And you tend to have a big exposure to more consumer type stocks. Is that fair to say?
You know what? We don't index. So we kind of complete non-indexes. So if you go back a couple of years, completely different. We had a lot of resource. So we'll go where we think is we're best positioned. So if you asked me to list the index, you know, what's the index weighting, is you'd be talking to the wrong guy. So at the moment we see consumer, the companies, if you take, you know, consumer, you're generating retail sales growth in real terms, 7%. So all the retailers are going to do well in that environment.
Do you still see value in that? In other words, what I'm trying to get at is, where do you see the opportunity at the moment in the equity space?
You know, the problem for managers like us, we've got a share like Mr. Price, done phenomenally well for us. It's now kind of 25.
So when do you get rid of it? That's
when
the
you
question.
get out? I mean, it's an old thing with the asset manager. I wouldn't be looking to buy more at these levels, and it's probably a level where you've done outstanding. Our normal process, it would be time to start thinking about leaving the party.
Kevin, do you agree with that? In terms of the retailers, are you leaving the party? Not all of them.
Not all of them.
Look, I think that the concern I would have from the retail perspective is that I can see why you had the big run up, and it had, because the growth in South Africa has really been a consumer story and a consumer income story. And consumers simply earned a lot more money and spent that, and they're topping up with a bit of credit. The problem is that momentum is now slowing. And you're not going to see that in the retailers for a little while. And then I suspect at some point, off these very high earnings levels, you'll suddenly realize, wow, the earnings aren't quite there. So I think that's ahead of us, and I'd be a little bit cautious about some of the retailers.
This cash exposure that you've got at the moment, just above 27%, is that relatively high?
Our total cash, I'm not sure reading it, we're running at about, the fund has got about 35%. It's about 66% invested in equities at the moment.
Yeah,
and funny enough, that's the long-term average. The long-term average is 65%.
All right, and then cash?
Cash is there's about 6-7% in quite long bonds. I heard your previous guy. We got quite long bonds in there. We got the 15-year bonds. We've got quite happy with the yield we're getting on that and the capital story on it.
But am I wrong on this 27% cash?
No, I think there's foreign cash in there as well.
Oh, there's foreign cash
in there. They've got
the
two separate, yeah.
All right, okay.
So you're not particularly then encouraged by fixed interest instruments. I mean, you have a relatively low weight, although you say you are happy with some of that. Yeah. And listed property?
Yeah, we've got some property that probably since that last fund fact sheet you're looking at, we have got some property unit trust exposure, which we see the yield's just great, and it's a good investment at the moment.
So for viewers, let me just clarify then that your local cash holding is sitting at around 22% and your foreign cash holding at 5.4%. That's in terms of the pie chart here.
And then you'd add in the bonds is about, I think about 6.
Exactly,
it all adds up to
6%.
about 35%.
Yes, exactly. Exactly.
Can we just come back to the equity portion? I know we jump in around a bit, but in terms of the banking sector, any interest in banks? We've obviously seen ABSA under a lot of pressure. Any exposure to local banks?
It's a good question. We've liked the banks. We've just seen better opportunities. At the moment, we're back liking them. They're moving up the things to do list. So we have started buying RMH. We like RMH. We think and the First Rand Group. That would be our choice. We just have reasons why we'd rather go into RMH in the holding company. And I think the bank is, so ABSA, I think there are particular reasons. I think the banks are good. There's a tailwind starting to blow for the banks again, and that's attractive to us.
What about Sasol, given the pressure that we've seen on the oil price of late?
Yeah.
I mean, this is...
Sasol's our token resource shares. We've got to have Sasol. We've got to have some resources. So we've got Sasol. Fundamentally, we're much happier about the prospects for oil than for things like iron ore.
But what is going to be the kicker for oil? Because if you look at, and I've tried to rationalize this in my understanding the Sasol play, which is obviously a wide play across fund managers. What is going to be the kicker for oil if you look at the manufacturing numbers or the PMIs today, Purchasing Managers Index, down across the board. So what's going to be the kicker for oil?
The biggie for oil is that 50% of world GDP is in developing markets, so there is economic growth. There's not the massive oil discoveries that are coming on stream. So the world's it's going to run out of oil, but oil's going to be fairly tight.
So, but that argument then you're not willing to apply to, say, Billiton. You're not willing to apply to other resource companies
because the margins are way too high. Take iron ore. Iron ore is a good example. There's a lot of iron ore around. You've just got to get a railway line to the sand pit, and you get out, you excavate, and you dig the stuff up. Oil isn't that abundant. There aren't the mega discoveries that are ready just stick in the oil well and take it out.
But that constrained supply that you're alluding to, you reckon 10 years out, we're going to see that constrained supply?
The longer term picture, supply is fairly constrained. And I think it's balanced. I think the Saudis, the Russians will balance it. A bit unfair because it's probably the worst performing share in our portfolio. But that's the reason we've got it there. We just feel having some resource exposure. And the other one on Sasol, which we do like, is it gives us some rand hedge cover. And there's a big kicker for South African investors in that. It just protects that closes that door a bit. We need to have some rand hedge.
Which stock, in your top 10 are you most excited about?
Omnia.
Omnia?
Yeah. Omnia is a great share. Well-run company. And you see, that's part of our mindset on the resource thing. We're worried on resources that supply gets a bit ahead of demand. So we're happy on the demand picture. We like the demand story. But supply just has to it's that last cargo ship that you can't sell, that you drop the price. However, guys like Omnia, we want to be the guys in the companies who's selling the spades to the miners. So Omnia is selling explosives. And another resource play, agricultural commodities, is another area we see a lot of growth. They sell explosives and they sell fertilizer. So that we'd much rather play the commodity boom from that side, because the growth story in the developing markets will carry on. But the iron ore margins, copper, much safer play to be.
And any other stocks that would fall into that type of category, an AECI type of?
Yeah, it's a similar thing. We just felt AECI, similar thing. There's the explosive side to it. A similar kind of company would be Bala World. We'd own that because they're selling the equipment to do the mining.
Rob, how about how about deep value shares that from time to time? I mean, I know at the beginning we were
Telkom,
saying,
Telkom.
That's where I'm going. Would a
read your
Telkom,
mind.
something like that?
You see, if a company hasn't got, now and again you get a fantastic asset play, but we're greedy. What we say we want, look, we want some earnings growth, because what tends to happen is you get a company with a ridiculously low PE, and all it does is get cheaper. And we've been burnt like that more times than anyone. You kind of get sucked in, and it's the good old value trap. But you can, I mean, we've got a company in there which is a little Japanese retailer. When we bought it, it had the entire market cap in cash. And on top of that, they were showing that they would have 10-15% earnings growth. You know, that's deep value, bring it on. You know, we kind of will take that. Just great, just a very low PE. It just
and
kind
lots of cash.
Well, if they've got lots of, if they've got the
It's always
market
a
cap in
positive.
cash,
Always a positive.
you know, there's not much that can go wrong.
And something like Nettel
we've
announcing their buy into more internet companies today, would that on the other side of the spectrum interest you?
No, not. Yeah, it's just too opaque.